This is Mixlot Production.
Hello, good day, and welcome to the program Money Talk. Money Talk is a program that x-rays business activities in finance, trade, industry, and investment. It also takes a critical look at SMEs and other business ventures. On Money Talk today, we will continue from where we stopped in our last episode. The issue of confirmation of MPC members and deputy governors nominated by President Muhammadu Buhari and confirmed by the Senate is over now. As a result of this, the first Monetary Policy Committee meeting, the decision-making body of the economy, held its first session to end uncertainties in the money market and give intending investors the roadmap to decide whether or not they want to invest in Nigeria. The highlight on today's program includes the consideration of the committee as it regards global and domestic economy. MPC cautions the executive arm of government to reduce its large allocation and spending during Federation's Account Allocation Committee, FAC. MPC calls for quick passage of appropriation bill, otherwise known as budget, and implementation of same around economic recovery and growth plan policy of the federal government, saying these will stimulate further growth of the fragile but growing economy. The committee's decision on monetary policy rate, cash reserve ratio, liquidity ratio, and asymmetric corridor will also come your way subsequently in this program. And lastly, we'll also take a critical look at the reaction from some financial journalists just after the Monetary Policy Committee meeting. So we'll take a quick break now, and just after that, we will go to the considerations by the committee chairman and the governor of Central Bank, Godwin Emefiele.
Inflationary pressures in the economy continue to moderate, with headline inflation year-on-year receding for the 13th consecutive month to 14.33% in February 2018 from 18.72% in January 2017. Month-on-month, food inflation fell by 133 basis points to 17.59% in February 2018, and core inflation also declined marginally by 38 basis points to 11.71% during the same period. These developments were attributable to the weak exchange rate pass-through to domestic prices. Money market interest rates reflected liquidity conditions in the banking system, as the average interbank core rate increased to 12.42% in February 2018 from 9.49% in December 2017. The open buyback OBB rate also increased to 13.19% in February 2018 from 8.46% in December 2017. The movement in the net liquidity position and interest rates reflected the combined effects of OMO auctions, foreign exchange interventions, and statutory allocation to states and local governments. The committee also noted the continuous improvement in the level of external reserves, which stood at $46.699 billion as at March 29, 2018. Similarly, the all-share index rose by 8.5% from 38,243.19 on December 29, 2017 to 41,504.51 on March 29, 2018. Market capitalization improved by 10.2% from 13.61 trillion naira on December 29, 2017 to 14.99 trillion during the same period. The committee observed that while this development may be a reflection of improved investor confidence in the economy, it cautioned that the management of the bank should carefully monitor the developments and to establish mechanisms to safeguard the stability of the foreign exchange market in the event of a sudden capital reversal. The committee observed the continued rise in oil prices, but acknowledged the inherent volatility in commodity prices and urged the bank not to relent in building external reserves buffers against any future price downturns and as a means of sustaining investor confidence in the economy. The committee noted the relative stability in the foreign exchange market with declining premia across all segments of the market. It observed with satisfaction the sustained high level of activity at the investors and exporters window of the foreign exchange market. The window continues to attract more investors, thus boosting foreign exchange supply, and consequently total foreign exchange inflow through the central bank increased by 73% in February 2018 compared with the previous month. This was attributed to the increase in receipts of proceeds from petroleum profit tax, royalties, and crude oil and gas. Total outflow also increased in February 2018 by 15.69% as a result of higher payments for invisibles, interbank transactions, as well as joint venture cash calls payments. Overall outlook and risks. Forecasts of key macroeconomic indicators give a positive outlook for the Nigerian economy in 2018. This is predicated on the quick passage and effective implementation of the 2018 budget, improved security, foreign exchange market stability, as well as favorable crude oil prices. On the downside, the committee noted the potential impact of the 2019 election-related spending against the weak backdrop of tax revenue efforts, herdsmen-related violence, and rising yields in the advanced economies. Indications in the US and the UK point to higher interest rates in the short to medium term. The considerations of the committee. The committee noted with satisfaction the gradual return to macroeconomic stability as reflected in the third consecutive quarterly growth in the real GDP in the fourth quarter of 2017. It also noted the continued moderation in all measures of inflation, as well as sustained stability in the naira exchange rate, and urged the bank to sustain the stability to avoid a mission drift. In particular, committee welcomed the narrowing of the exchange rate premium between the BDC segment and the investors and exporters window of the foreign exchange market. Overall, the committee noted that the recovery of the economy was strengthening in view of the return to growth of the services sector. As the fiscal sector continues to settle its outstanding liabilities, it reduces its domestic debt profile, thus increasing the liquidity of the banking system. However, the Monetary Policy Committee observed increasing monetization of oil proceeds as evident in the growing FAC distribution relative to the 2017 levels of disbursements. Committee urged the government to initiate strong stabilization programs and to freeze the growth in its aggregate expenditure and FAC distributions in order to create savings badly needed to stabilize the economy against future oil price related shocks. Notwithstanding the general improvement in macroeconomic conditions, committee noted the rather slow pace of moderation of food inflation. It also took note of the potential risks of a pass-through from rising global inflation to domestic prices. Members, however, expressed confidence that the tight stance of monetary policy would continue to complement other policies of government in addressing some of the structural issues underlying the stickiness of food prices. The committee noted that at 14%, the policy rate was tight enough to rein in current inflationary pressures. The committee therefore reaffirmed its commitment to price stability conducive to sustainable and inclusive growth. The committee noted with satisfaction the gradual implementation of the Economic Recovery and Growth Plan in an effort to stimulate economic recovery. In the same vein, the committee urged quick passage of the 2018 appropriation bill by the National Assembly so as to keep fiscal policy on track and deliver the urgently needed reliefs in terms of employment and growth for each citizenry. The committee noted the relatively strong balance sheets of the deposit money banks and the stable outlook. This is in spite of the concentration of non-performing loans in a few sectors, which the committee observed was satisfactorily being addressed by adequate mechanisms established by the bank to address the phenomenon. The committee also noted that as government pays off its huge contractor debts, a sizable portion of these non-performing loans will be addressed. The committee urged the bank to strengthen its supervisory oversight and early warning systems to promptly identify, monitor compliance with extant prudential regulations, sustain macro-prudential policy, and manage emerging vulnerabilities in the banking system. The committee reiterated the bank's commitment to delivery of low-interest credit as evidenced in its bold steps to adopt unconventional monetary policy to aid credit flow to vulnerable and growth-enhancing sectors of the Nigerian economy. The committee therefore enjoined the bank to continue to support and encourage credit delivery at single-digit interest rate through mechanisms in the interim, while encouraging the banking system to establish frameworks to increase credit delivery to the employment-generating sectors of the economy. In consideration of available data and evolving macroeconomic indicators, the Monetary Policy Committee is committed to revisiting its decision in the short to medium term as the fundamentals evolve.
Now, that caution from MPC to FAC is timely, especially as the Federation's Account Allocation Commission has not disbursed less than 500 billion naira on a monthly basis. Now, the monetary aspect of the economy is saying you must exercise caution and save for rainy days. Up next is a decision on interest rates and other parameters.
In reaching its decision, the committee appraised potential policy options in terms of the balance of risk. The committee also took note of the gains made so far as a result of its earlier decisions, including the stability of the foreign exchange market, the moderation in inflation rate, as well as the restoration of economic growth. The launching of the Food Security Council by the federal government to improve food sustainability is a step in the right direction. The committee was concerned about the fiscal distortions associated with absence of buoyancy between the GDP growth and tax revenue, and all the fiscal authorities to deploy appropriate corrective measures to address this phenomenon. The committee was of the view that further tightening will strengthen the impact of monetary policy on inflation with complementary effects on capital flows, indeed positive effects on capital flows and exchange rate stability. Nevertheless, it could potentially dampen the positive outlook for growth and financial stability. However, committee of the view that loosening would strengthen the outlook for growth by stimulating domestic aggregate demand through reduced cost of borrowing. This may, however, lead to a rise in consumer prices, generating exchange rate pressures on the currency in the process. The committee also believes that loosening could worsen the current account balance through increased importation. On the argument to hold, the committee believes that key variables have continued to evolve in line with the current stance of macroeconomic policy and should be allowed more time to fully manifest. In consideration of the foregoing, committee decided unanimously by a vote of all members present to retain monetary policy rate MPR at 14% alongside all other policy parameters. Consequently, MPC voted unanimously to retain 1. MPR at 14%, 2. CRR at 22.5%, 3. Liquidity ratio at 30%, and 4. Asymmetric corridor at plus 200 basis points and minus 500 basis points around the MPR.
Again, for almost 2 years now, the NPC held its rate, despite calls from some financial analysts and the World Bank for tightening of policy rates. Let's now take a look at the reaction from some journalists who were at that meeting. Were they expecting any change? Is there anything they had wanted the NPC to have done as it regards the economy?
Like they say, the economic managers always know the economy best. But the truth about it is that even from last year, December, analysts have been predicting that from March, hopefully the second MPC of the year would reduce the rates. But the central bank governor has, when he was talking about the considerations of the committee, I had a strong feeling, of course, that they were going to hold it, considering the fact that they say that, yes, they believe that loosening the rates would probably grow the economy, but there are other dangers. And these are dangers that have been there, or they have been citing for the last 6 months. So we now ask ourselves, when are we going to get out of these dangers for them to be able to loosen it? Because whether we like it or not, without loosening the rates, it tightens the liquidity sector, it tightens the credit sector. The rates of credits will still be high. So the basic thing is, I think that they should be able to balance it up. They have held these rates for this long. In fact, I don't think I can remember where the rates have been held this long in Nigeria, but I think now they have held it, next MPC, they should consider losing it.
Okay. They're also talking about, increasing liquidity to commercial banks. And now that interest rates have been held, the sector.
You see, they say they are increasing, the CRR is still 30%. So everything is still the same.
Subsequent meetings, what should we do?
Okay, well, subsequent meetings, of course, just as they're losing the rates, they have to increase CRR. They should increase CRR. And probably, no, they shouldn't. They should reduce CRR rather and increase the ratio for the banks. But basically for the rates, just as they're bringing it down, they should also reduce the CRR so that banks can have access to more funds to be able to give people at reasonable rates.
expected that the rates will be held steady, bearing in mind that the macroeconomic conditions are improving a little bit. At least Nigeria's economy is out of recession, but the economy is still witnessing a fragile growth of 1.92%. Is not uhuru yet. Inflation, however, that is at double digits, is still trending downward from what it was early 2016, from about 19-18% to 14.33%, the last figure shows. So I wasn't expecting anything different. I think for now it makes sense that they still hold it, watching all the parameters. Bear in mind also that this is an election year. There will be increased election spending. Inflationary trends are there. So some other conditions, the base effects are still there. So I think holding the rate at this time, perhaps, was not an uncomfortable thing for me to bear. I think, yes, I think as time goes on, there needs to be some kind of easing, as it were, from the central bank. Even if it's not about the headline, even if it's not about the headline inflation, but about some other rate like the CRR and the liquidity ratio. We do also know, but what I'm also bothered about is the amount that banks borrow from the central bank lately. It has increased. I'm also bothered about the collateral conditions that have been imposed by the CBN to banks so that they can, give to the people that want credit. So we're even saying getting collateral was difficult before. It will be more difficult now because that's for new loans. So there are a lot of things that the MPC should be able to tinker with to be able to get the economy right on track, because we're still talking about we need to have effective credit delivery system to enable the banks lend, not just the deposit money banks, but also the microfinance banks that get to the downtrodden. How do you explain that a microfinance bank is charging close to 30% for loan? Which poor man would assess that? So those are the things that they should be looking at moving forward to be able to unlock that growth and for us to have strong growth to create jobs.
Sincerely, I'm not disappointed with the outcome of this meeting. I expected that it will hold, that the CBN that the MPC will hold the rates. First of all, this MPC is new. They are just coming, even though the governor said that they've been orientated, but they are new. So, because they are new, it's likely that they will also want to wait, tarry, see what is going on before they make such decisions. Secondly, on my own, I didn't think that MPC will do anything different from what they did today. Look at inflation, for instance. Inflation is still high. Inflation is still, to me, it is still very high because I look at myself and I look at my pocket and I see the way it is hitting me. Even though the CBN, the government authorities, economists will say, yes, it has come down from 18%, it is now 14% and so on and so forth. But if I look at what is going out of my pocket, I still feel that it is high. And again, you see, when we look at this economy and what exactly is the nexus between basic rates, CBN rates, and banks, even if they reduce it now, the banks will gain. Banks have never really followed CBN. They have never. When it was low, when MPC, for instance, was 11 or so, nothing changed. You can still go to the bank and borrow. The banks still do whatever they do. They still continue to deduct money from us. They still continue to lend very high. They will usually have their excuses. They will talk about infrastructure, they will talk about electricity, they will talk about security. They always have excuses not to really reduce their own interest rate. So I didn't think much will change. I thought that CBN will hold as they held.
No surprises, right? From the foregoing, the interest rate is held at 14%. while the cash reserve ratio is at 22.5%. The liquidity ratio is at 30%, while the asymmetric corridor is at plus 200 and minus 500 basis points around the interest rate. The committee argued that further tightening will strengthen impact of the economy, while loosening may worsen the account balance and encourage imports. Rates are now held for the ninth consecutive time. That's where we draw the curtain for this week's edition on the program. Now, for sponsorship, advert placement, and participation on this program, you can call the numbers on your screen. I am your regular host, Gabriel Kuma, saying bye for now.